Hello, this is a video by Integrity Capital, and the objective today is to show you as a business owner how to be pre-qualified or to get a sense for pre-qualification uh, from a financial perspective, meaning how does the financial institution you're using actually come to the conclusion that they want to lend you money based upon the financial information in here. So what we're going to do is we're going to start off by talking about how to calculate your business cash flow or businesses that allow you to give the lender the information they need to determine whether you can get a loan or not. That'll be the first component. Then we'll actually show you how to run the cash flow for your personal taxes, your personal tax returns, your 1040s. That is a part of that equation. And then we'll show you how to put in your personal debts that will show the payments and the loan balances. We'll go on to show you how to put in your business debts and what that looks like. And then finally, we'll show you how to calculate the new loan that you would be obtaining, and then what these ratios down here mean, which is the final number or numbers that the lender actually looks at in order to obtain a loan or not. So let's start off. So the very first thing that you're going to do is determine how many businesses you have. That's the first piece. So if you only have one, which is your main operating company, then you'll put the name of the company in this section up here, which you would have gotten from us as a model to input this, so you can do this at the same time. And then you'll put the dates up here, so the years, I should say. So if it's 2016, 2015, whatever those years are, you're going to input those in here just so we get some consistency. And realize that as we go through all of this, you want to maintain the same periods of time as we go down. And the reason why that's so important is because it's going to allow you to calculate an appropriate debt service coverage ratio, which is what we'll talk about later in the video here. So make sure you put in, it could be a full fiscal year, could be the interim period, September, October, November, whatever that is, put that here, and then the prior year here. And then the very first thing you're going to do is calculate, or input, I should say, the net income for that fiscal period into this cell right here. The year prior, you're going to put the net income here as well. If you're just pulling it off your profit and loss, very simply it will say net income. If you're pulling it off your tax return, depending on what you file, if it's an LLC, S Corp, or a Corp, it should say something to the extent of operating income at the bottom of the form, or net income as well. So make sure that you calculate it. And remember, net income is very simply put, it's your sort of gross revenues, or effective gross revenues minus all of your operating expenses, what it cost you to function the business for the year prior to paying your taxes. So just remember, that could be your salaries, could be the rent that you pay, could be the interest payments you pay, could be the marketing, the accounting, and the list goes on and on. So that is what that number is, and make sure that you get the appropriate number there. The next one you're going to add or input in here is the interest. The reason why is because what we're trying to do is to get to what is called an EBITDA, or earnings before interest, taxes, depreciation, and amortization, or sometimes referred to as EBITDAR. It's the final number of cash flow from your business that's available to pay for the debt payments that you will be borrowing. So we want to add back any interest payments, not the principal and interest, but just the interest for that year here, which gets us to that final number. You can, again, get that. It should be pretty simple, just interest on the actual P&L for profit and loss. The next thing we're going to do here is to put in rent, to add rent back in. Now, the only time that this is going to take place is you might be leasing a location right now, and perhaps you're going to replace that rent. You're not going to rent there. You're going to move out. And so if that's the case, you're going to replace that rent with the new building you're buying. Then you would add that back. So whatever it is for those years you've been paying on your tax return or the profit and loss, you will add that back in. You'll just put that number right in this field. Okay. Next down the line is adding back depreciation and amortization. And this is very important because those are non-cash expenses. Non-cash expenses are items that you can deduct on your tax return, which helps you with taxes, but they're not actually money that goes out the door. So whenever you buy a building or you buy equipment or something to that effect, you can actually depreciate that because it's losing value. And so we want to add that back in here to get us to a cash flow number. The owner's salary is probably not going to be applicable for you, so don't worry about that. And then what will happen down here is the model in these yellow sections automatically calculates all those items that we just input up here. So as you'll see here, it says $195,000 for 2016 and $175,000 for 2015. Again, if you have more businesses, you can do the same exact thing here. And again, we've added a third one as well. If you have more than that, you can certainly add more fields down here to sum up to a total. Now, what will end up happening is that depending on if you have a few businesses, this will total up to a total business cash flow number. And again, this is EBITDA, earnings before interest, taxes, depreciation, and amortization, and also rent. So we're trying to get to this pre-number that's going to give us the actual free cash flow that's available to service debt. So that is the business section of the underwriting. The next piece is to pull out your tax returns for the last 2 years. Depending on what year you're in or how far you're in, you might have not filed for the prior year, or maybe you're in the middle of it. But either way, you want 2 years of tax returns that, again, lines up with this year, so we have some equivalency here. And you're going to go to your 1040. It should say it on the front, and it's the section that's going to show all of the wages, interest, dividends. You'll see all of these categories on there. And what we're going to do is we're just going to go down the line. We're going to pull out the tax return. We're going to see if there's any section in here that shows whether there's wages, that you've paid yourself any wages that year. And remember that these numbers are going to be numbers that we believe are going to be consistent year after year. If there's anything that was sort of what we would deem a non-reoccurring expense, or non-recurring income, I should say, it's probably not going to go on here. So if you feel like that wage is going away in the next year, chances are we're not going to put it on there. If you think it's going to be consistent going forward, you'll definitely want to put it on there because we want to reference that as an additional source of cash flow. As we go down the line, you'll see taxable interest. So if you have an investment that pays you interest and it's consistent, we want to put that number in there. If you have, let's say, an investment with the municipality, so maybe it's a state bond or something, and that is tax-exempt interest that's going to continue on, you'll see that as a line item on the 1040, and you'll put that number in here. As we go down the line, you'll see ordinary dividends. And again, that could come from stock investments, so on and so forth, or possibly other investments. And you pay yourself a dividend, and if that's consistent, we put that number in here. Qualified dividends are dividends that perhaps are qualified from a tax perspective to have a minimized tax burden. So again, if that's a consistent year after year number, generally speaking, these aren't, but you'll put that number in there if it's reoccurring. Alimony, again, this could be non-applicable, but possibly if you're going to receive alimony year after year going forward, definitely input that there. Business income and loss, this you will actually pull from your Schedule E, or I should say your Schedule C. So you'll have to actually go to a couple of pages down from your tax return. And if, let's just say you have a sole proprietorship, you don't file your tax return separately from that, then you'll actually go down and input this number in here. Now, we want to be very careful here, because if you're pulling your profit and loss and you haven't already done it up here in the business section, then you can put it in here. If you've already put the information from your profit and loss statement in the business up here, then you can't do that down here either, because that'll be sort of a double whammy. You'll have already done it once and now you're doing it twice. So if you've already included it up here for your business income and loss, and it's on your Schedule C, then just leave this at a 0. Capital gain or loss, this is if you've sold an investment or investments. It will show on one of your schedules the actual capital gain or loss. Again, my encouragement to you is not to put this in here unless it's a reoccurring item. And chances are it's not. Most businesses, might have something every so often, but you might want to leave that out. IRA distributions, again, these generally, unless you're retired, are non-applicable or non-reoccurring. So you might want to be careful to leave those out. And then pension and annuities, again, could be ongoing, but that's going to be a judgment call. And then the final one is Schedule E items. And the Schedule E items could be perhaps rental properties. And so you can go down, scroll down to the Schedule E items and actually look at the net income of those properties, add back depreciation, add back interest, okay, and any non-recurring expenses there. Because again, you're trying to get to a net cash flow number here. So you want to make sure to look at that. Schedule E items could also be your other businesses. And again, if you've already put those up here on the Schedule E items, then definitely don't double hit it. So just make sure you're cognizant of that as you're going through and generating cash flow. Okay, so what we're going to do here now is to look at the personal debts. So what am I talking about? So anything that is personally in your name, it could be a home mortgage, auto loan, credit card, maybe you did a loan to somebody else, or they owe you money, or I should say you owe them money, you would put it in here. If it's in the business name, it goes down here, but if it's personal, it's in your individual name, then it's going to go up here. Again, we want to know what are the annual payments, what is the outstanding loan balance. Auto loan, again, what's the annual payments, put it in here, what are the loan balances. Credit cards, same thing, what are you paying, and just annualize that number, and then what is outstanding. And you just keep doing that on down the line until you see down here a total that will calculate, and this will also total your outstanding loan balances. So pretty straightforward. Business debts, you're going to do the same thing, but on the business side. So equipment, could be a line of credit, could be vehicles, could be an actual piece of commercial real estate. Whatever those are for the business or businesses, you are going to put in the annual payments here along with the loan balances. And again, you're going to see down here that it will calculate a total amount on the balance, and then a total amount on annual payments, okay? So again, pretty straightforward. Now you'll notice something down here. This says new loan. One of the things we want to make sure we calculate in the overall amount is what is going to be the impact on you borrowing whatever it is you're borrowing. And so this is automatically going to go in there as well because we want to know how that actually affects your cash flow. So what you'll do is you'll go down here and you'll figure out what is that loan amount I want to borrow. Maybe it's 90% or 80% of the purchase price. You'll put that number in here. Just put that right in this field. Then you'll go down here and you can start playing with the rate. What do you think going rates are at the time? Is it 4%, 5%? You'll choose an amortization down here. Is it going to be amortized over 20 years or 25 years? And again, you typically for owner occupied, it's between 20 and 25. This field will automatically generate a payment that is on an annualized basis, and then it will pull it up right here. So you'll notice that this goes up here in the debt payment every year, and then this number goes up here to give you a total. So after you've done all that work, you've done the cash flow for the business, you've done the personal tax return cash flow, you've done the personal debts in here and the business debts here, and calculated what your new loan payment's going to be like. Then the final number down here is what's called a global debt service and also a company debt service coverage ratio. And what do I mean by that? Well, let's first start off talking about debt service. A debt service coverage ratio basically is all of that cash flow that you have coming in from business and personal, and then it's divided by all of the debts that are going out. So it's basically the inflows of cash divided by the outflows of cash from debt payments. And you'll notice that this number is a multiple, so it's 1.70 times and 1.52 times. Well, what that's telling us is that if it was 1.00, that would be exactly at break even. It means that for every dollar that was coming in the door, there is a dollar going out the door. In this instance, for every dollar that is going out the door, there's $1.70 coming in the door. So you can support the debt payments based upon your cash flow 1.70 times globally. That means all of your personal outside income, all the business income divided by all the business debts minus the personal debts. So again, think about globally speaking, that's all the whole picture of you and the business and everything, and even if there's partners involved. So it literally is a 70% cushion above break even. This has a 52% cushion above break even. So the actual company debt service coverage ratio is just looking at the actual company itself. It's not taking into consideration personal debts or personal income. It's just looking, can the company themselves support the actual debt service? And in this instance, it can 1.72 times or 72% above break even, which is good, or 54% above break even. And the magic number for you is 1.2 to 1.25 times. They want to know that you have at least a 20% to 25% cushion to support the debt service. And typically it's for 2 years in a row. That's why we use this number here. So again, debt service coverage ratio is taking all the inflows divided by all of the outflows. So again, this was here to help you calculate for your business whether you qualify to borrow money based upon just the cash flow component. In order to be successful, you need to have at least a 1.25 times. So again, this is Integrity Capital. My name is Dave Cotter, and God bless.